of the webinar. I'm from MRPeasy, and I'm here with our guest today, Yesim Tilley, and she's a manufacturing accountant based in the UK. So thanks for joining us, Yesim.
Thank you. Thank you. No, thank you for having me here, Shane. Thank you. It's an absolute pleasure.
Yeah, really looking forward to this webinar. So I'll just give a
Yeah.
quick introduction. So Yesim Tilley is a chartered accountant for manufacturing businesses, founder of Skynet Accounting, and also author of a book called How to Unlock Cash to Fuel Manufacturing Success. So I'll just start off with the
Yes.
question. What made you first get interested in working as an accountant in manufacturing?
Oh, yes. I love this question. I was only 15 when I started as an apprentice in a paint manufacturer. And then I moved on to Ford car manufacturing. And it just totally changed my life altogether. But even then, I had a question in my mind that was, how come all this massive operation I'm seeing here actually connected to financial performance? How is it actually captured? How is it measured? How is it actually converted into cash generation? And at the time, I couldn't actually get a clear answer from anybody. And I spent 20 years since then working across manufacturing, like including electronics, plastics. And then I realized that most manufacturers have the same problem. The problem is they don't have the product costing in place. What I mean by that, they don't truly know how much it costs to make. And I work with some that they had system and processes in place and they had the costing on the system as well, but they didn't regularly update it or they were not correctly implemented. So when I started my own practice, I knew I had to focus on that gap because this is where the manufacturers are losing money. And this is the business critical area for any type of manufacturers. So that's why.
And could you maybe explain what the difference is between manufacturing for a normal business or accounting for a normal business and accounting
Yeah.
for manufacturing businesses?
So accountants process transactions, they prepare accounts, they manage the taxation, payroll, so on. They make the business compliant, which is crucial because it's, as you know, it's a legal requirement. Every businesses have to do this, and my practice do that as well. I cover compliance work for my clients. But where my work is slightly different is that in manufacturing business model, significant capital is invested into machines, people, inventory, factory space, and all other supporting resources. Those assets cost to the business every single day, whether the business is producing efficiently or not. So that means the critical question is here, how effectively is that investment being converted into profitable product, cash generation, and business growth? So this is where I focus on. So the question is, where does the product costing actually work on this? So product costing gives management visibility of how efficiently capital is being used throughout the operation. So it helps identify where the value is created, where the margin is being lost, and most importantly, where the cash is trapped. So if the costing structure doesn't exist in a manufacturing business, then I build that foundation from scratch for them. If they have the costing in place and they have the system in place, then I review, I challenge them, and I improve, I correct them. So alongside, I do accounting and compliance, tax support as well. So for giving business owners a complete financial management solution under one roof, that's what I do.
Okay, so I think you're well equipped to answer these next questions. So the topic of today is basically about how Businesses expect a certain profit. Then after the job is done, it's much lower than what they'd expected. Nobody in the business knows what happened or where the missing profit went. So this is something that you see pretty often. Maybe you could expand on what I said.
So yes, the question is, where is the profit is going? Where is the margin is going? So it usually starts with the predetermined margin. An expectation is built around when the pricing is usually put together. So in my experience, what I've seen, a sales director or business owner come up with the costing, material cost X amount, labor cost X amount, we got some overheads there, and then adding a margin on top, and they arrive at selling price. So let's say you're expecting a 30% gross margin, but the business is reporting at 20%. So the question is automatically, okay, so what happened to that 10% margin? What if that 10% margin wasn't there in the first place? So the first question I would ask, what did it actually cost to make versus what did we think it would cost to make? Because if the costing is inaccurate, the margins were never there in the first place. Second area is the production efficiencies. So the question is, what really happened during the production process from start to finish? Starting points from the time that order is received all the way through the product is shipped. Did we have any machine breakdowns? Did we have any excessive setup times? How was the scheduling done that month? What was the rework? What was the scrap rate? And the third area is the pricing, because once we understand the true cost of that product and what happened during the production, then we can assess whether the selling price was sufficient to achieve that target margin. So the purpose is to understand where the margin was lost so that we can take action to improve the performance going forward. So what I often find that businesses heavily focus on sales volume, which is fair enough because we need the sales coming in. But strong sales doesn't always bring the profit, doesn't always generate the cash in the business. So from my point, in my view, if the costing, operation, and pricing are not aligned, the expected margin never materializes. That's all
So
I can say.
in a way, all these costs are kind of the foundation. You can't just expect to have a lot of sales. You have to understand all of your costs.
Yes, there is a chain in the operation, a product has got a journey in that process. And knowing that true cost of that product makes a huge difference. Huge. And if you don't know, then it gets chaotic environment and you basically can't make a strategic decision. It becomes very difficult to take that product into a market, the market that maybe there's a huge competition. Maybe the market is setting the price for that product. And it just makes it very difficult. You could either price yourself out of that market or you could underprice and you end up with a loss-making product. So you need to know exactly how much it costs, the real cost I'm talking about here, to make one single unit. So that's how it is.
So I think it would be useful to talk about some of these costs that businesses might not be considering. Maybe hear from an expert what they actually need to look for. So maybe you could talk about machine hour rates and how a lot of businesses don't account for this.
Okay, so machine hours are usually misunderstood in many cases. That's what I've seen in a way. So in my experience, they are usually misunderstood because people set them as a fixed number and assume all machine hours are the same. In reality, not all machine hours consume in the same way. If you walk around the factory, you will see different machines with different utilization rate, different setup requirement. They even individually have got their own operating characteristics. So they are not all the same. So another misconception is that machine hour rate relates to the time the machine is running. So in reality, true cost of operating a machine is much more complex because you need to consider everything involved per machine basis to support that machine to run. So for example, if I give as example to make it simple to understand is like you need to include cost of investment, cost of maintenance, services, collaboration, floor space, energy consumption, all routines involved in that machine, any overhead requirement or anything that's supporting that machine to run. And the other complex area, sometimes it can be get wrong, is the productive hours are miscalculated. So every machine has got its own theoretical capacity, and there's an expectation from that machine, but it doesn't mean that factory can achieve that level of output in practice. So the other element is that about production planning element, because if the products have got the product family and requires the same setup, requires the same machine run, and if those products are not scheduled together, which I've seen this with make-to-order businesses usually, and they lose out on excessive setup time and they lose out on the capacity because they end up with an excessive setup, unnecessary setup time, and it consumes capacity and it costs. So these are actually classified as like hidden cost. They are not visible to the management first instance, but it catches up later on as inefficiencies when you actually look at the final result in your P&L report. And so my point is, if you want accurate product cost, you need to understand both financial assumptions and what is actually happening on the shop floor.
And machine hour rates, is that one of the major costs that
Yes.
isn't accounted for?
Yes, in most cases, I've seen, it's easy to put material costs because usually bill of materials are available in most cases anyway. Labor costs, obviously you get this report from the payroll, and machine hour is either averaged or not included at all. Yeah, it's very common to miss those costs altogether.
So yeah, maybe if you could talk now a bit more, now that you've talked about the right way to do it, maybe you could talk from personal experience how you see a lot of manufacturers managing costs in the wrong way. So maybe if you could give some examples, it could probably
Yes.
help quite a bit.
In my experience, I've seen many different ways. Some rely on assumptions, some rely on estimations, expectations, while others have got the costing processes and system in place. However, the same issues often appear. So one of the most common one is using average costing across all products using single rate. So when this happens, business leaders lose visibility on which products are genuinely generating profit in the business and which products are consuming margins. From my experience, I've seen this in electronics manufacturing when I analyzing top 10 revenue generating products. They were using one SMT machine rate used for all products, regardless of complexity of the products, complex setup time, batch sizes, production volume, and it just wasn't right. And the other example I can give, I've seen this in plastics as well, where the plastisol cost was average across the whole product type, but it wasn't based on how much that product is consuming that liquid materials. That wasn't even considered. So average costing doesn't work in manufacturing, and it's very useful if you would like to put your estimation together, or if you need a quick calculation just to get an idea. But for manufacturing, you really need to know your true cost, real cost. The other example I can talk about is with using standard costing. Standard costing works really well if the journey of that product is based on standards. But what happens is products go through that standard process, and it gets to a point where product requires customized activities, such as customized level requires labor assembly, or maybe specific machine run, and so that it requires additional cost in a custom base that they don't get captured in the costing, and it distorts the costing altogether. And the other area I've seen, when the urgent order arrives, then they prioritize this urgent order for any reason, and all this rescheduling and restarting and setup time and so on starts. But it's never captured that additional setup time, additional prep times, they never get traced back to that customer. It never traced back to that product itself. So every time you stop that operation, it costs lost contribution. So that's another area. But with time, also product costing becomes out of date. There is also no dedicated person actually in the business managing and updating and validating those costing structure. That's another area. So as a result, this creates a gap between operational performance and financial performance. And in reality, the costing architecture doesn't support the journey of that product in the production process, and it leads to loss of margin, poor pricing, and poor decision making.
Just to sort of finish off, maybe you can give some practical advice how to fix product costing, how to get a more accurate view of production costs. I know you said that there's a lot, you can go pretty deep on this topic, but maybe if you can give some quick ideas where to get started.
Okay. So in my view, if you don't have the costing in place right now, and I would suggest, my recommendation is just take your top 3 revenue generating products, and you need to go into a lot of detail, by the way, and assess through what is really happening during that production process to that specific product. And then you will need to go into each stage from the time the order is received and right at the end of shipping, the time that it is shipped. And then you will need to total up all the costs, including bill of materials, the labor cost time, any routings, machine run time, any packaging inspection, quality, everything involved in that production process. And then I would suggest you compare with what you are charging to your customers, and the result can be shocking, but this exercise alone, if it's done properly, it makes a huge difference, and it gives you that commercial awareness straight away. So it's a really good practice. And in terms of the software and using the logic on the costing as such, using a system, I mean, should we go ahead with the system first, and what is the first direction we should take? I would say, so software is just a tool, relies on the input, information, and assumption you put in. So before implementing any system, business needs to understand how their products are actually made. So that means understanding the production process, product families, bill of materials, routings, labor requirement, machine cost, overhead allocations. And once that foundation is put together in place, the system becomes very powerful because it captures the data, monitors the performance, highlight the variances between expected and actual. If the foundation is wrong, then we will rely on that wrong information and will throw some variances or reports information. Sometimes it gets very confusing because you don't know the root cause of those variances. Or sometimes people lose confidence on the system as well. But it's all about foundation. So from my view, just build the costing foundation first, link it to your software, and then off you go. And it shouldn't be the other way around. That's all
Yeah,
I can say.
I would just second that basically that with systems like MRPeasy, it can help you track your materials, labor, overhead.
Yeah.
It can give you really good visibility of your costs and how much it takes to make a product. But if your data is wrong and you're not working on the right assumptions, then the software uh, can't fix that. So I would just agree with you that yeah, your foundation
Yes.
is
Yes.
important.
Yes, you definitely need to get your foundation right, put it all together, and then link it to your system. And in fact, if your product is a standard product or maybe a standard process through a process where maybe from a certain process it gets customized, then again, using a system, it's like a permanent result. It's like a permanent result. And then maybe it will just need updating once a year or when the fluctuations happen. So nothing is having a system in place is it's great.
We're just closing out here, have about 5 minutes left.
Yeah.
So yeah, again, if anyone wants to add a question, you can add it to the chat. But just to close out,
Mhm.
I guess you kind of covered some of this, but maybe if listeners could take away one thing from the webinar, what would it be?
I'll say having the confidence in your numbers, knowing exactly where the business is making money, at the same time where the business is not making money. And it gives you that strategic mindset, and you will be able to make strategic decisions with knowing the reality. And especially in today's fast changing environment, having accurate and timely information is more important than ever. And it helps you understand which products, customers, and activities are creating value. My website is skynetaccounting.co.uk, but you could also email me directly if you got any questions. It's skynet@skynetaccounting.co.uk.